Is Kinder Morgan a good investment? Let's get started with the model. This is a large cap company, 55 billion market cap. They're trading at $25 a share, and they have 2.2 billion shares outstanding. This company owns and operates interstate and intrastate natural gas pipelines, storage systems, natural gas gathering systems, natural gas processing, treating facilities, and liquefied natural gas. They also own and operate refined petroleum products and condensate pipelines. The company handles various commodities including gasoline, diesel fuel, renewable fuel, chemicals, ethanol, metals, and petroleum coke. Its CO2 segment produces, transports, and markets CO2. They own and operate a whopping 82,000 miles of pipeline with 139 terminals. Founded in 1997, headquartered in Houston, Texas. Let's take a look at their financials. The way you value a company is you estimate the free cash flows into the future and then you discount those numbers back to today's value. That's what we're doing in this video. And free cash flow is cash flow from operations minus capital expenditures. Free cash flow is pretty steady. It was highest in 2021, 4.4 billion. It's still pretty good at 4 billion in the trailing 12 months. Really good margins. They convert 26% of their revenue into free cash flow. They had their highest revenue in 2022 with their lowest free cash flow. They probably were just investing a lot into CapEx. Net income is the profit or loss on the income statement. It's revenue minus expenses. That's also pretty steady. Peaks in 2022 at 2.5 billion, 2.4 billion in the trailing 12 months. Once again, pretty good margin, 16%. It was lower in 2021, 11%. You want to see at least 10% to give you room to breathe. Just in case something happens one year and expense is higher than normal, you won't lose money. I think a good goal for most companies is 20%. Once you hit that level, then things are going really well. Revenue is a sales for the company, and a lot of their revenue is dependent on the price of oil. The higher the price of oil, the higher their revenue. The lower the price of oil, the lower their revenue. They had 19 billion in 2022, their highest. That's down to 15 billion in the trailing 12 months. They pay a really nice dividend, 4.6%, which they can afford. They can cover that 1.6 times with their free cash flow. We estimated 4 years of future free cash flows. We also estimated a terminal value, which is all cash flows past year 4. That's 54 billion. We discounted those numbers back to today using weighted average cost of capital. We get a value of the company of $48 billion. We divide that by 2.2 billion shares. And we get a calculated stock price of $22. They're trading at $25, so they're trading at a 15% premium. It's a sell according to the model. Sometimes when a company pays a high dividend, the stock seems overvalued. Because if they didn't pay that dividend, all those cash flows will go back into the business, which makes the company more valuable. But when they strip out a lot of cash and give it to their investors, it makes the company less valuable. There are 45 companies in the same industry as KMI, and if they have a number in red, they're worse than the median. If they have a number in blue, they're better. Most companies spend a lot on CapEx in this industry. That's the investment in property, plant, and equipment. They spend 2.5 billion. They spend a lot on their infrastructure. They have pipelines and terminals and different facilities. They have one of the better debt to equity ratios, 1.0. For every dollar of equity, they have $1 of debt. They pay a dividend of 4.6%, which is lower than the median. This industry tends to pay a really high dividend. Look at Frontline, 8.7. They generate 4 billion of free cash flow. ET is number 1. I own a lot of ET. I bought it in January 2022. With dividends, I'm up about 110, 120%. This company ranks 4th in market cap. The Canadian company Enbridge is number 1. Price to book, 1.8, which is better than the median. That's stock price over book value per share. PE of 23, it's a bit high. That's stock price over earnings per share. Price to free cash flow between the median and average, 14. ET is number 1 at 8. That's why I own ET and I love it. Price to sales, 3.6. That's stock price over revenue per share. They generate 15 billion of revenue. Look at ET, 83 billion leading the way. And KMI's 5-year annual revenue growth rate is 2%, pretty low. Kinetic Holdings is 66%. Kinetic, like KMI, is also a Texas midstream company, but Kinetic's main focus is on the Delaware Basin. If you put 10K into KMI 10 years ago, you'd be in the red most of the time. Currently, you'd be up a little bit if you included dividends. Your 10,000 would be equivalent to 11,000 today. Not much of a return. So to summarize, I have them trading at a 15% premium, Ranking 5 out of 10. The company looks good. I don't think it's super special, so it's middle of the road. Would I buy it? 5 out of 10. I like the business model, I like the dividend. I don't like the fact that the stock really hasn't done much the past decade. Ratios 5 out of 10, pretty average ratios. Financials a little weak, 4 out of 10. Free cash flow is down 10% from 2021, revenue down 8%. Let's look at their latest 10Q. Here's their income statement. The third quarter of 24, the third quarter of 23. These two columns are the trailing 9 months for 23 and 24. Revenue 3.7 billion, that's down from 3.9 billion. For a company like this, it doesn't necessarily mean they sold less product. It just could be the price of oil came down a lot. And they give a breakdown of their revenue. 2.2 billion is services, which is up. Commodity sales is down. So this does indicate the price of oil came down, which is why their revenue came down. Let's see if they give a different breakdown of their revenue. Here's a different breakdown of the revenue. Of the 3.7 billion, 2.2 billion is from natural gas pipelines, 700 million from products pipelines, which means anything other than natural gas that goes through their pipelines falls into this segment. Terminals, 500 million. CO2, water, 319 million. Let's look at this income statement. They give percentages. Revenue is down 5% from the third quarter of 2023, down 200 million. Cost of revenue is up 24%. Cost of revenue improved a lot. It improved 27%. It was 1.4 billion last year, now it's 1 billion. That's really impressive when you lower your expenses more than your revenue decreased. Operations and maintenance is up a little bit, up 7%, 730 million to 790 million. That's operating and maintaining their pipelines, terminals, etc. Depreciation, depletion, and amortization, 587 million, similar to last year. G&A is up 9% from last year, 176 million. These are all the expenses outside of running their day-to-day business, like the rent at their headquarters, insurance, etc. 100 million of non-income taxes. Operating income is up 8% with lower revenue. Revenue went down 5%. The reason our operating income is higher is because of lower expenses. Operating income a little over 1 billion last year, a little over 900 million. They have investments in other companies. They earned 211 million. They spent 466 million of interest on their debt. Pre-tax income 760 million, 113 million of taxes. So net income 650 million. Their EPS is 28 cents. Last year it was 24 cents. That's up 17%. And it looks like they're buying back stock. Their shares outstanding went down 9 million from last year. Let's take a look at the balance sheet. Current assets 2.2 billion. Current liabilities 4.7 billion. A really weak current ratio, which means they probably need to add some debt to get through the next 12 months. I wonder why they keep their current ratio so low. Their main current asset is accounts receivables. This is how much money other companies owe them when they sell on credit. And they also have 526 million of inventory. They have 71 billion of assets, and most of a midstream company's assets is the PP&E. This company is their pipelines. 38 billion of PP&E. They do a lot of acquisitions as well, 20 billion of goodwill. Their liabilities of 39 billion. Most of that is long-term debt, 30 billion of long-term debt. Then another 2 billion in the current portion of long-term debt. This 2 billion is long-term debt. It's just due within 12 months. So at one point, it was due in 5-10 years when they initially took on the debt. Here's a breakdown of the long-term debt. The 2 billion that's due within 12 months is 300 million of commercial paper. Commercial paper is unsecured short-term debt. Many companies use commercial paper to fund payroll, to fund inventory. Most commercial paper is due between 30 and 270 days, so it has a really short duration. They have 1.5 billion of notes due in 2025, a pretty low interest rate, 4.3%. 111 million of preferred securities with an interest rate of 4.75%. A bulk of their debt is their senior notes, 29 billion. They talk about some of their senior notes. In February of this year, they offered 2 series of senior notes that totaled $1.25 billion, paying 5% interest. Also 1 billion of 2029 senior notes at 5.4%, and 2.2 billion at 2034 maturity. Let's go back to the balance sheet. Assets minus liabilities equals equity, 30 billion of equity. They raised 41 billion from selling their business, selling stock. They lost 10 billion from running their business. The reason there's a big negative is because they paid out so much in dividends. Accumulated deficit is a sum of a company's prior net incomes minus the sum of the dividends they paid out. Let's look at a statement of cash flows. This is for the trailing 9 months. The way you calculate operating cash flow, you start with net income $2 billion, you add back the non-cash items on the income statement, depreciation $1.8 billion, and you adjust for changes in working capital. When you use current assets or current liabilities, that does affect your cash. When you sell a product but don't get paid for it, that's a cash outflow. So when you extend credit, when you give accounts receivable, that's a cash outflow. But when the people pay you back for the product, it's a cash inflow. It looks like people pay for that product in this time period. They may have extended credit last year, and now this year they're paying for it. They spent a lot on CapEx, $1.9 billion. Just to maintain their pipelines and infrastructure is expensive. I'm not even talking about expanding and growing the business. Just maintaining what they have, they spend a lot of money. They spent $58 million on acquisitions. They say it's in note 2. Let's see what note 2 says. They talk about 3 acquisitions here. The North McElroy unit acquisition for $60 million. That was in June of this year. They acquired AVAD Energy Partners. This is going to add 1.25 billion barrels of oil per day. It also could be a candidate for CO2 flooding. They sold a bunch of their units in the Permian Basin, and they received an interest adjacent to the SACROC unit. SACROC is located in the Midland Basin. That's in West Texas. This is a mouthful, but it stands for the Scurry Area Canyon Reef Operators Committee. They also sold their Oklahoma midstream assets for $43 million. So the first is an acquisition, the next 2 is divestitures. Let's go back to the statement of cash flows. They had to pay down $8.9 billion of debt, so they issued $8.8 billion of debt. They paid out $1.9 billion of dividends. So in their financing section, that a cash outflow of $2.2 billion. Let's look at a stock on Simply Wall Street. Its last price, $56 billion market cap, flat in the past week, up a solid 52% in the past year. Here's a stock price since 2011. It started out at 31, then peaked in 2015 at 44. And this big drop was due to the big crash in oil. This chart shows the price of crude oil the past 25 years. A big crash in 2008, a big crash in 2014 and 15, which coincides with this big crash right here. So if the price of oil goes down a lot, so will this stock, even if the company's fundamentals did not change. And since that big drop, the stock hasn't recovered. It was over 20 right before the big crash in April 2020. Not the COVID crash, the big oil crash. Remember when oil prices became negative? It fell to about $11. It has done well since that point, but it's really a timing thing. If you buy an oil stock at the wrong time, it could take you forever to recover. Here's Energy Transfer stock. You have the big run up to 2015, then a huge crash in 2015, 2016. Then it did run up, came down a little by April 2020, then the big oil crash. And then it's come up since that point, but still trading a lot lower than its all-time highs. Let's go back to KMI. Simply Wall Street's valuation is 19. They say the stock is 31% overvalued. Here's Simply Wall Street's DCF. They use a WACC of 8.2%. They project 10 years of future free cash flows. So 2025, they're projecting $3.2 billion. If you discount that at 8.2%, it's $2.9 billion in today's dollars. And they project up through 2034. And of course, discount that back to today. They do a terminal value, that's $50 billion. They present value that, that's $23 billion. So the value of the company in today's dollars is $42 billion. Divided by 2.2 billion shares, so a stock price of 19. That's how they get to 19 down here. 15 analysts priced this stock at 24. They say it's slightly overvalued. Here's their revenue since 2013. It was 14 billion. Over the next few years, it came down to 12 billion. Its peak was over 19 billion in 2022. Now it's come down to 15 billion. Here's their debt since 2013. It was 36 billion. The highest was 45 billion. It's come down to 32 billion. And their equity is always really close to their debt. As you can see here, they're almost identical currently. We saw their debt to equity ratio was 1, so this makes sense, 101%. And this green line on the bottom is their cash. They only have 111 million of cash. They're paying their next dividend on 11/14. Their dividend yield was 11% in 2015. That's when the stock price crashed. That's why the yield went up so much. But they lowered their dividend to be more in line with the stock price. So that's why the yield came down to 2.5%. When it crashed in 2020, the yield got up to 8%, but of course came back down. The forecast is for the yield to be 5% by 2026. The CEO's salary in 2017 was $400K, now it's $500K. Total compensation $12 million, tenure as CEO 1.2 years. In the past year, lots of insider selling, one small buy. Insider sales in the past year were about 1.4 million shares. 2/3 of the company is owned by institutions, 20% by the general public, and 12% by insiders. Richard Kinder and William Morgan founded this company. Kinder is the biggest shareholder at 11.6%. Next is Vanguard at 9%. And you can see a lot of big companies on this list. Kanye West Capital Advisors. Amundi, the big French asset manager. Their employee count was 11,000 in 2013. Now it's a little under 11,000. And the ticker trades on the New York Stock Exchange, Deutsche Börse, Xetra, London Stock Exchange, Wiener Börse, Mexican Bolsa, and Sao Paulo Bolsa. So if you want to learn how to master reading financial statements, click on the video in the top right corner. Thanks for watching.